Hi, welcome back. If you watched the silver market this week, you probably noticed something that doesn't quite add up at first glance. The Federal Reserve, under its brand new chair, just delivered one of the more hawkish messages we've heard from the central bank in years, and yet silver is still sitting above $70 an ounce. Normally, when the Fed signals higher rates are coming, precious metals get hit hard and fast. That's the textbook reaction. But this time, the metal barely flinched before bouncing right back. So today we're going to slow down and actually understand what just happened, why it matters for anyone holding cash, savings, or metals right now, and why the usual playbook for predicting silver's next move might not be working the way it used to. Let's start with the headline event because it's a big one. For the first time in a long while, the United States has a new Federal Reserve chair, and his name is Kevin Warsh. He was sworn in earlier this year after being nominated by President Trump, and this week marked his very first meeting running the show at the Federal Open Market Committee, which is the group inside the Fed that actually decides what happens with interest rates. Now here's what's interesting. Trump pushed hard for Warsh specifically because he wanted someone who would cut interest rates. That was the expectation going in. But the economic backdrop Warsh inherited looks nothing like the one anyone imagined a year ago, and that's largely because of a conflict that broke out earlier this year between the United States, Israel, and Iran. That war pushed oil prices sharply higher, and when energy costs rise, inflation tends to follow close behind, because oil touches almost everything, from the gas in your car to the cost of shipping a package to your door. So Warsh walked into his first meeting facing inflation at its highest level in more than 3 years, sitting above 4% on the headline number. And instead of the rate cuts everyone expected, the Fed left rates unchanged for a fourth straight meeting, but more importantly, it signaled that the next move might actually be a hike, not a cut. Think about it this way. Imagine you're driving and you expected the road ahead to be downhill, easy and fast. Then suddenly the road tilts uphill instead. That's roughly what just happened to market expectations. A majority of the Fed's own policymakers now think a rate increase by the end of this year is more likely than not. That's a complete reversal from where things stood just a few months ago, when the average forecast was actually leaning toward a cut. Now this is important because higher interest rates usually work against precious metals like silver and gold. Here's the simple logic behind that. When rates go up, things like savings accounts, treasury bonds, and other interest-bearing assets become more attractive because they pay you more just for holding them. Silver, on the other hand, pays you nothing while you hold it. There's no interest, no dividend, nothing. So when safer assets start paying more, some money naturally drifts away from metals and into those interest-paying alternatives. That's why, historically, a hawkish Fed message tends to put downward pressure on silver and gold prices. And we did see exactly that reaction initially. The day before this announcement, silver actually dropped around 3% in a single session, as traders priced in the more hawkish tone. But then something else happened that complicated the picture, and this is where the second major piece of this story comes in. Just as the Fed was delivering its hawkish message, news broke that the United States and Iran had reached a preliminary agreement to formally wind down their conflict. This wasn't just another ceasefire extension. It included a plan to reopen the Strait of Hormuz, which is one of the most important oil shipping routes on the planet, along with a path toward easing sanctions on Iranian oil exports. Here's why that detail matters so much. A huge portion of the world's oil passes through that narrow waterway every single day, and when there's a war happening nearby, ships get nervous, insurance costs spike, and oil supply gets constrained, which pushes prices higher. So when officials announced that the strait would reopen and tensions would ease, oil prices and the broader inflation outlook both started to cool off almost immediately. Let's break this down further because the interaction between these two stories, the Fed and the Iran agreement, is really the heart of why silver did what it did. On one hand, you have the Fed sounding tougher on inflation, which should weigh on metals. On the other hand, you have a major de-escalation in the Middle East that takes pressure off oil prices, which actually reduces one of the very reasons the Fed felt the need to sound tough in the first place. These two forces were pulling in opposite directions at almost the exact same moment, and the market had to digest both of them together. That's a big part of why silver fell hard one day and then climbed right back the next, eventually holding above the $70 mark instead of collapsing the way a purely hawkish Fed message might have suggested on its own. Now let's bring in the third piece of this puzzle, because this one is less about headlines and more about what's quietly happening underneath the surface of the silver market itself. This involves something called COMEX, which is the major exchange in New York where most of the world's silver futures contracts get traded. When people buy and sell silver on COMEX, the vast majority of those trades never actually involve anyone taking physical delivery of real metal. It's mostly paper contracts changing hands, settled in cash. But a portion of those contracts do eventually require actual silver bars to be delivered, and that's where things have been getting genuinely tight. Here's a useful way to picture it. Imagine a warehouse that holds silver bars, and those bars are split into two categories. Some are called registered, which means they're available and ready to be handed over if someone demands delivery. Others are called eligible, which means they meet the quality standards, but the owner hasn't made them available for delivery yet, almost like inventory sitting in the back room that isn't on the shelf for sale. Right now, the registered category, the silver that's actually ready to ship out the door, has been shrinking relative to the number of paper contracts that could theoretically demand that metal. Industry trackers describe the current coverage ratio, which compares available registered silver to outstanding contract claims, as sitting in what's considered stress territory, somewhere in the mid-teens % range. In plainer terms, there's a lot more paper silver promised than there is physical silver sitting ready to be delivered tomorrow. This matters because of a structural story that's been building for years now, not just months. Silver has run a supply deficit, meaning the world has used more silver than it has mined and recycled combined for 6 consecutive years, according to industry analysts. And the reasons behind that demand aren't going away anytime soon. Silver isn't just a shiny metal people buy as coins or jewelry. It's a critical industrial input. Solar panels need it. Electric vehicles need significantly more silver per unit than traditional gasoline cars. Data centers and the entire build-out of artificial intelligence infrastructure also lean on silver for electrical components. So you have steady, growing industrial demand running headfirst into a shrinking pool of available above-ground metal, and that tension doesn't resolve itself overnight. Now here's where it gets genuinely interesting for anyone watching the delivery side of this market. COMEX silver contracts have specific delivery months, and as those delivery dates approach, something called First Notice Day comes into play. That's essentially the point where holders of a contract have to decide whether they're going to demand actual physical silver instead of just settling in cash. As that day gets closer for the upcoming contract month, traders and analysts watch closely to see how much open interest, meaning how many contracts are still outstanding, gets converted into actual delivery requests. If a large number of contract holders suddenly decide they want real metal instead of a cash settlement, that puts direct pressure on those registered inventories we just talked about, and it can create what people in the industry call a delivery squeeze. Let's use a simple analogy to make this concrete. Picture a small bakery that sells reservation tickets for fresh bread every morning, far more tickets than they actually have ovens to bake bread for. Most days, that's fine, because most ticket holders don't show up wanting bread at the exact same time. They're happy to just hold the ticket or trade it to someone else. But if one morning a much larger than usual number of ticket holders all show up at once and insist on real bread right now, the bakery suddenly has a serious problem because the promises on paper vastly exceed what's actually sitting in the oven. That's roughly the dynamic playing out with silver and COMEX, except the ovens are warehouses and the bread is 1,000-ounce silver bars. This is a good moment for a quick reminder, since we're talking about market mechanics that can genuinely affect real decisions. If you're finding this breakdown useful, consider subscribing, because we go through these moving pieces of the economy every week in a way that's meant to help you actually understand what's happening, not just react to headlines. No pressure either way, just glad you're here watching this one through. So let's connect all three threads together now, because that's really the story behind why silver held above $70 despite a hawkish Fed. You have a new Fed chair signaling that interest rates might rise rather than fall, which on its own should pressure silver lower. You have a major geopolitical de-escalation with the Iran agreement, which cools inflation fears and oil prices, partially offsetting that hawkish pressure. And underneath both of those headline stories, you have a physical silver market where registered inventories remain historically tight relative to industrial demand and outstanding paper contracts, creating a kind of underlying support that doesn't show up in daily headlines, but shows up in how the price behaves when bad news hits and doesn't fall as far as you'd expect. It's worth being balanced here, because this isn't a story with a guaranteed outcome, and nobody serious about markets should pretend otherwise. There are real risks on both sides. If the Iran agreement falls apart, and it's worth remembering that ceasefires in this conflict have broken down before, only to be patched back together, oil prices could spike again, but this time alongside a Fed that's already leaning hawkish, which could be a genuinely difficult combination for metals. On the other hand, if inflation does cool the way the Iran deal suggests it might, that gives Warsh and the rest of the Fed more room to ease off the hawkish rhetoric later this year, which would remove one of the bigger headwinds silver has been facing. And then there's the physical delivery situation, which could either stay a slow-moving background story or, if a wave of delivery demands hits at once, become a much bigger short-term price event. Here's a simple mental framework you can use to follow this going forward without needing to track every headline in real time. Think of silver's price as being pulled by three ropes at once. One rope is interest rate policy, and it pulls harder on silver when rates are expected to rise. Another rope is the macro and geopolitical backdrop, things like the Iran situation, oil prices, and the general state of inflation, and it pulls metals lower when tensions ease and higher when tensions flare. And the third rope is physical supply and demand, the actual tightness of available metal versus how much the world needs for industry and investment. And that rope has been pulling steadily in one direction for years now, regardless of what the other two ropes are doing on any given week. When you see silver behave in a way that seems to defy the headlines, like holding steady after a hawkish Fed meeting, it's usually because that third rope, the physical one, is quietly doing more work than people realize. Looking ahead, there are a few realistic paths this could take, and it's worth holding more than one possibility in mind, rather than betting everything on a single outcome. One path is that the Iran agreement holds, inflation gradually cools as energy prices normalize, and the Fed finds itself able to ease its hawkish tone later this year, which would remove pressure from silver from the policy side, while the physical tightness continues to provide a floor underneath the price. Another path is a more turbulent one, where geopolitical tensions resurface, oil climbs again, and the Fed feels forced to follow through on a rate hike, creating real headwinds that even physical tightness might not be able to fully offset in the short term. A third path, and perhaps the most likely one if history is any guide, is something messier and more gradual, with periods of both pressure and support trading places over the coming months as new data and new headlines arrive. Now, why should any of this actually matter to you if you're not a professional trader watching screens all day? It comes down to a few practical things. If you hold any savings in cash or bonds, the path of interest rates directly affects how much real return you're getting after accounting for inflation, and that's worth understanding regardless of how you feel about metals specifically. If you've ever considered precious metals as part of a long-term financial plan, understanding that prices are being shaped by genuine structural supply and demand forces, not just speculation or short-term sentiment, can help you think about it with a clearer head rather than reacting emotionally to a single down day or up day. And more broadly, watching how policy decisions, geopolitical events, and physical market mechanics interact gives you a much better lens for understanding the economy as a whole, which touches everything from the price of groceries to the rate on your next car loan or mortgage. To bring this all together, what we watched this week was genuinely a clash of forces rather than a simple, single-direction story. A new Fed chair sent a hawkish signal that should have pushed silver lower. A major geopolitical agreement around Iran helped ease the inflation fears that were partly driving that hawkish stance in the first place. And beneath both of those headline-grabbing events, a physical silver market that's been running tight for years continued to provide quiet support that doesn't always make the news, but consistently shows up in how the price actually behaves. None of this comes with guarantees, and anyone telling you they know exactly where silver goes from here with total certainty isn't being fully honest with you. But understanding these three forces, the policy side, the geopolitical side, and the physical supply side, gives you a genuinely useful framework for making sense of what you're seeing, rather than just watching numbers move on a screen without knowing why. That's where we'll leave it for today. As always, this is meant to help you understand the moving pieces of the market more clearly, not to tell you what to do with your own money. And any decisions about investing should be made with your own research and, ideally, a conversation with a financial professional who knows your full situation. If you found this breakdown helpful, like genuinely helps this channel reach more people who are trying to make sense of all this the same way you are, and subscribing means you won't miss the next piece of this unfolding story. Thanks for watching, and I'll see you in the next one.